Grab started as a way to avoid getting scammed. In 2012, Anthony Tan was a Harvard MBA student watching his friends get overcharged by Kuala Lumpur taxi drivers. The fix seemed simple, an app that showed the fare up front. No negotiation, no surprises. 13 years later, Grab holds $1.3 billion in outstanding loans, $1.3 billion in customer deposits, and just recorded its first full-year profit of $200 million. That is not what a taxi app does. The ride-hailing was never really the point. It was the data. Every trip logged a location, a payment, a behavior pattern. Millions of them, across 8 countries for over a decade. Banks had been trying to reach Southeast Asia's unbanked population for generations. Grab did it in 12 years, with a motorcycle and a phone. Anthony Tan didn't set out to build a bank. In 2012, Grab launched in Kuala Lumpur as a ride-hailing alternative, one of dozens of apps trying to do what Uber was doing, but for a different market. Southeast Asia looked like a problem. 700 million people, 8 countries, dozens of languages, traffic that made Manhattan look organized, and a banking system that had spent decades deciding most of this population wasn't worth the trouble. Out of Southeast Asia's 400 million adults, 198 million were completely unbanked, and another 98 million were underbanked, having a bank account but no access to credit, investment, or insurance. That's over 70% of the adult population. To a traditional bank, that's a risk problem. Indonesia's largest bank, Bank Rakyat Indonesia, had spent decades building physical infrastructure to reach these people. Over 8,600 branches and service posts across the archipelago. Grab had a different idea. Not branches, drivers. By 2023, Grab had over 5 million registered driver partners across the region. Every one of them a moving point of contact. Every transaction a data point. Every route, every payment, every tip recorded. But in 2012, none of that was obvious. Grab was just trying to survive. Uber had more money, more engineers, and a playbook that had already worked in dozens of cities. The obvious outcome was that Grab would get crushed. It didn't, and the reason why explains everything that came after. Uber treated Southeast Asia like every other market. Grab understood something Uber didn't, that Southeast Asia wasn't one market. It was 8 different ones, with different payment habits, different regulatory environments, different levels of smartphone penetration. In Indonesia, most people didn't have credit cards. Cash was the default. Uber's cashless model, the thing that made it elegant everywhere else, made it nearly useless here. Grab added cash payments, then GrabPay, a digital wallet. Then it let drivers accept payments for groceries, food delivery, bills. Each addition seemed tactical, a response to local conditions. In 2018, Uber admitted defeat. Not quietly. Uber sold its entire Southeast Asia operation to Grab in exchange for a 27.5% ownership stake in the company. Goliath didn't get crushed. Goliath decided that owning a piece of the winner was smarter than losing to them. Grab had won the region. Now it had to figure out what to do with it. Here's what makes this strange. Traditional credit scoring works by looking backward. You need a loan history to get a loan, which means if you've never had one, you don't exist to the financial system. Grab's credit model considers things no bank ever thought to ask. How often does your phone battery die? Do you take the same route to work every morning? Do you tip your driver? These behavioral signals, invisible to a bank, obvious to an app that runs on your phone all day, became the basis for underwriting loans to people who had never held a credit card. The result? Loan eligibility increased by roughly 50% for people with no formal credit file. In 2026, FICO gave Grab its Decision Award for financial inclusion. The same organization that built the credit scoring system that had excluded these people for decades was now giving awards to the app that worked around it. By 2025, Grab's financial services segment revenue had grown 37% year over year to $347 million. its fastest-growing segment for the third consecutive year. The wallet was already winning. Grab lost $3.4 billion in 2021. That number looks like failure. It wasn't. Every dollar of that loss was spent buying loyalty, subsidizing rides, making Grab the default before anyone else could. The goal was simple. Make sure that when Southeast Asian consumers reached for their phone to do anything, pay, eat, travel, borrow, they reached for Grab. It worked. Slowly, then all at once. By the fourth quarter of 2023, Grab posted its first ever profitable quarter. $11 million net income. A number that sounds small until you remember what it replaced. Years of billion-dollar losses, one after another. Then 2025 happened. Full-year revenue hit $3.37 billion, up 20%. Adjusted EBITDA reached $500 million, up 60%. Net profit, $200 million. Grab's first profitable year since going public. The losses stopped when Grab stopped subsidizing growth and started converting its installed base into financial services customers. The ride-hailing division was the entry point. The exit was always going to be the wallet. By the end of 2025, Grab's net loan portfolio had grown 120% year over year to $1.18 billion. Customer deposits across its digital banks in Singapore and Malaysia reached $1.3 billion. On current trajectory, the loan portfolio is expected to reach $2 billion by end of 2026. Not loans to wealthy urban professionals, to drivers, to small food stall owners on Grab Food, to the micro merchants who had been invisible to formal finance their entire working lives. Over 60% of small and medium businesses in Southeast Asia could not get a loan when they needed one, even though they employed 69% of the region's workforce. Grab didn't just give them credit. It gave 46 million consumers, plus millions of merchants and drivers, access to formal finance for the first time. It gave them a financial identity. And it did it not through regulation, not through development aid, not through decades of financial inclusion policy. It did it because keeping drivers on the platform was good for business. Southeast Asia's banks didn't lose to a better bank. They lost to an app that knew their customers better than they did, and had spent a decade proving it, one $2 ride at a time. The pattern isn't unique to Grab. WeChat did it in China. M-Pesa did it in Kenya. The infrastructure for financial inclusion didn't come from regulators or development banks. It came from tech companies that needed a reason to keep users on their platform. That should probably make someone uncomfortable. When your bank is also your taxi, your food delivery, and your insurance provider, and it knows your location, your income pattern, your spending behavior, and how often you let your phone battery die, the question isn't whether Grab is a good bank. The question is, what happens when it decides it doesn't need to be anything else?